Buddy, and welcome to chapter 14. As you all know, we're winding down the semester very quickly. I'm going to talk about chapter 14 in this recording, and also talk just briefly about chapter 16 in the next recording. But this is chapter 14, and deals with basically dividend policy. As we've talked about earlier in the semester, when a company issues stock, either preferred stock or common stock, then common stock would typically pays a fixed dividend, and preferred stock pays a fixed dividend, and common stock can pay a dividend. The board of directors can choose to pay dividends or not, and typically this depends on the investment possibilities of the corporation. And normally the way it works is, if a corporation feels that they can take their net income and put that net income back into retained earnings and then reinvest that into new projects, and they can do a better job of making money or making a higher return than you can, then that's what they're going to do. So some companies that have been famous for this are companies like Microsoft. Microsoft for years never paid a dividend. And that's because they were taking the money from the earnings, reinvesting it back into the company, and creating new projects, very profitable projects. The stock price was increasing rapidly and splitting, and increasing rapidly and splitting. And so the stockholders weren't bothered by not receiving a dividend. It was not a problem to them, because the stock price increase more than made up for the lack of the dividend. On the other hand, some companies, when they have net income, they may not have a lot of profitable projects to invest in, and so they prefer simply to pay out those earnings as dividends to the stockholders and say, okay, here, stockholder, you take your dividend, and now you find an investment for your money. And so some companies pay out a large percentage of their earnings in dividends. Others pay out no dividends whatsoever. And again, we're going to discuss this in this chapter, and this is going to be a fairly brief chapter. There are no calculations in this chapter, just basically some definitions and a little bit of theory. Okay, so chapter 13, dividends and repurchases. And this we'll skip past this. This just kind of shows sort of where the distribution to shareholders, or where the dividends, where that comes from. And this is talking about a distribution policy, also known as a dividend or dividend policy. And the dividend policy defines the level of cash distributions to shareholders, so what percentage is paid out. The form of the distribution, is it a dividend, or is it a what's called a stock repurchase, where they're buying back shares of stock from stockholders, and the stability of the distribution. Does the company pay a dividend, the same dividend each and every year? Do they pay an increasing dividend? Do they have to decrease their dividend? Because that goes a long way in affecting a stock's price. Now, when it comes to dividends and capital gains, as we talked about earlier in the semester, essentially in its most basic form, if you have what's called a long position in a stock, which means you're buying the stock in hopes that the price will go up so that you can resell it. So I'm not talking about short sales. I'm not talking about any type of derivative instrument sales like puts or calls. I'm just talking about basic buying stock and then hoping to sell it at a higher price. You can make money two ways. That's through receiving dividends or through a capital gain, which means the stock price goes up. And with this, there's three theories of investor preference. Now, these are all, keep in mind, these are heavily into finance theory. So you may listen to some of these and think, well, that doesn't really make a lot of sense. But again, these are based on very famous studies that are done by very famous professors. And again, real world sometimes takes a back seat to theory when it comes to some of these papers. But these do help shape dividend policy by a lot of our major corporations. Now, the first one listed here is what's called the dividend irrelevance theory. And this is by two professors named Modigliani and Miller. That's why we simply abbreviated M&M, but Modigliani and Miller. And what the dividend irrelevance theory says is that firm value is determined only by expected earnings and business risk. So it doesn't matter how you split up net income, because it's all going to be the same. Okay, so earnings and business risks are the only determinants of firm value. It has nothing to do with the dividend policy. The second theory listed here is what's called the bird in the hand theory. And the bird in the hand theory says that firm value will be maximized by a high dividend payout ratio. And the reason for this is it makes sense, as you've probably all heard the saying that a bird in the hand is worth two in the bush. What this saying is that CAF's dividends are less risky than the potential of a capital gain in the future. So if the company has earnings and they pay the stockholders the dividends now, the stockholders have that cash in their hands, and that is much less risky than the possibility of letting the company keep the earnings, reinvest it in the company, and hopefully the stock price will go up in the future. So the bird in the hand theory. And then the third theory is what's called the tax preference theory. And this says that investors prefer low dividend payout ratios because dividends are taxed at a higher rate than long-term capital gains. So this is saying just the opposite of the bird in the hand theory. It's saying that investors don't want companies to pay out much in dividends because dividends are taxed at a higher rate, and some investors would rather have long-term capital gains at which they can pay lower tax rates. And to keep in mind, you don't pay tax on capital gains until you actually sell the stock. So you may have some huge capital gains sitting there on paper, but until you actually sell those shares of stock, then you have no tax liability. So again, three different theories regarding companies and should they pay out dividends, should they not pay out dividends. Now, when it comes to dividend policy, you should also take into account the following. The first one is an increased dividend is a signal from management of expected higher future earnings. Now, this is a very strong signal to the stock market. Typically, when a company increases its dividend payment, so let's say it typically pays $1 per year per share, and it goes to $1.10 per year per share of stock. That's a positive signal, because what they're saying is management is telling you, we think we can maintain this increase in dividend, and it's because we're going to be making more money, or we're deciding to pay out more in terms of dividends to shareholders for some other reason. Now, they typically won't increase their dividend payment unless they know they can maintain that increase, simply because a decrease in the dividend payment is a huge negative signal to the market, and that typically hurts a stock's price. So an increased dividend typically helps a stock's price. Decrease in a dividend typically hurts the stock price. Now, of course, there are special circumstances, such as the end of last year, when a lot of companies, based on not being certain about what the tax policy was going to be for 2013, a lot of companies paid what was called a special dividend, and that was simply they were freeing up a lot of cash, paying it to shareholders so that they could claim it on their 2012 taxes instead of having to pay it in 2013. Another item that should be taken into account is what's called the clientele effect. And the clientele effect says that firms will attract investors who like the dividend payout policy. So that's simply saying, and this makes a lot of sense, this is simply saying that if you're a person who likes, who wants to receive dividends as part of your income, maybe you're a retired person, and that's part of your income is the dividends that you receive from stocks that you own, then you're going to seek out companies and you're going to buy stock in companies that pay high dividend rates. An example of this would be utilities. Utilities companies typically pay high dividends compared to other industries. On the other hand, let's say you're a young person. You don't necessarily want the dividend payments coming into you. You'd rather take the long-term capital gains. You're going to seek out and invest in companies that are maybe high growth companies that are going to take their earnings, and instead of paying out the dividends to you, they're going to reinvest it in the company, and hopefully the stock price will increase. You will have capital gains on paper, but you actually won't have a tax liability until the shares are sold. So the clientele effect simply says that, investors are going to find companies that have their preferred dividend payout ratio, or there's high or low, and they're going to invest in those companies. And that makes a lot of sense. Now, this is just some historical information talking about dividend distributions over time. It says typically the percent of total payouts as a percentage of net income has been stable at around 26 to 28%. Also says the dividend payout rates have fallen and stock repurchases have increased. And repurchases now total more dollars in distributions than dividends. Also, a smaller percentage of companies now pay dividends. When young companies first begin making distributions, it is usually in the form of stock repurchases. And dividend payouts have become more concentrated in a smaller number of large, mature firms. So that's simply saying that recently, smaller companies, they're buying back their shares of stock from shareholders when they have extra cash instead of paying it out in dividends. And typically, not always, but typically, when they repurchase their stock, they feel that the stock is currently undervalued. Otherwise, they're not going to buy it if they think it's overvalued. And again, that should send a signal to shareholders. And this just gives you an idea of some of the dividend yields for selected industries. For example, the software industry. The stocks companies listed in the software industry typically pay a dividend yield of approximately 2.41%. Food industry, 1.52%. You can see electric utilities, as I mentioned earlier, they typically pay high dividends, 4.44%. And tobacco industry, 1.74, banks 1.76. So again, you can compare this to what you're earning on maybe your certificate of deposit at your local bank, or your savings account at your local bank. Okay, because that's essentially what this is. This is the percentage yield that you're earning. And then, of course, you have the possibility of a capital gain also, but this is just talking about the dividend yield. Now, which of these theories is most correct? You could argue about this all day. If you ask 10 different professors, they'll give you 10 different answers. It says here, the first bullet point, that some research suggests that high payout companies have higher required returns on stock, supporting the tax effect hypothesis. Other research using an international sample shows that in countries with poor investor protection, high payout companies are valued more highly than low payout companies, and empirical testing has produced mixed results. So essentially, this is saying that there is no one theory that's most correct, at least not yet. Now, stock repurchases are a slightly different way for a company to distribute its cash. Now, I said they can pay dividends, but they can also buy back their shares. It says repurchases is simply buying their own company's own stock back from stockholders, and the reasons for repurchases would be it's an alternative to distributing cash as dividends. They could do this to dispose of one-time cash from an asset sale. They could do this to make a large capital structure change, or they could repurchase to use when employees exercise stock options. Again, just an alternative to paying dividends when a company has excess cash. And the procedure for a stock repurchase, there's no one exact way, but this is sort of in general how it would work. First of all, a firm announces its intent to repurchase stock. And then they can do this three ways. They can have a broker purchase it on the open market over a period of time. They can make a tender offer to shareholders. That's simply they're offering a purchase price to shareholders. Or they can make a block or what's called a targeted repurchase. So that's buying one huge block of shares of stock. And it says the firm doesn't have to complete its announced intent to repurchase. So they can announce it, they can fully plan on repurchasing the stock, but something may go wrong. Maybe they don't have enough, the people won't sell back at that price. Maybe they can't find a block of stock big enough that they're interested in purchasing, or they could simply change their mind and go a different direction. Now, this is kind of interesting because a lot of times a repurchase signals that the stock is undervalued, and that will occasionally, you'll think, okay, the stock is undervalued, which means it should be purchased by investors. But this says, as I'm reading here, the first bullet point, it says the announcement of an intended repurchase might send a signal that affects stock price, and the previous events that led to cash available for distribution affect stock price. But the actual repurchase has no impact on stock price because of two reasons. First one is, if investors thought that the repurchase would increase the stock price, they would all purchase stock the day before, which would drive up its price. And secondly, if investors thought that the repurchase would decrease the stock price, they would all sell the stock the day before, which would drive down the stock price. So the signal may have an effect on it, but the actual repurchase on that particular day, typically the information from that signal is already priced into the stock on the day of the repurchase. Some advantages of a stock repurchase. One is stockholders can choose to sell or simply not sell. So it's not like they're forcing you to sell your stock back. They're simply saying, we would like to buy it back at a certain price. If you want to sell, fine. If you don't, that's okay also. Secondly, it helps avoid setting a high dividend that cannot be maintained. Third, income received is capital gain rather than a higher taxed dividend. And fourth, stockholders may take as a positive signal that management thinks the stock is undervalued. So again, there are some advantages to dividend payouts, both high and low, and also to stock repurchases. Some of the disadvantages of repurchases, one is it may be viewed as a negative signal, and that would be that the firm has poor investment opportunities. This one's actually not that popular of a theory. So what they're saying here is simply, if they're repurchasing their own stock, that means they have nothing else to do with their cash. They don't have any great investment opportunities on the horizon, so they're simply using that to buy back their stock. And secondly, the IRS could impose penalties if the repurchases were primarily to avoid taxes on dividends. So again, two disadvantages of repurchases. And then also, this talks just very briefly about stock splits. And I bring this up because that's something that a lot of students have questions about when a stock either has a normal stock split or what's called a reverse stock split. And it says here, and again, this is when, for example, if you have a share of stock and the price is increasing, a company can declare a stock split, for example, a 2-for-1 split. What that simply means is that, let's say you own 100 shares of stock currently valued at $10. No, let's change that. You own 100 shares of stock currently valued at $50 per share. Okay. So you have $5,000 worth of stock. 100 shares, $50, $5,000. And the company decides it's going to have a 2-for-1 stock split. So what that means is they are going to give you 2 shares for every 1 share that you currently own, but they're going to cut the price of the stock in half. So now, instead of owning 100 shares of stock worth $50 per share, you now own 200 shares of stock worth $25 per share, which still equals $5,000. So you're not any better off as an investor. It's just that the stock is split, and they can have a 2-for-1 stock split, they can have a 3-for-1 stock split, they can have a 5-for-1 stock split. You know, it doesn't matter. You're not really any better off. It's just you own more shares at a lower cost. Now, the reason for this is that there's a widespread belief that the optimal price for a stock is anywhere from, you know, $20 to $80 per share. And so when a stock gets up to $100, $150, $200 per share, Apple stock, you know, trading in excess of $400 or been up to $700 per share, they think, you know, it just that mentally investors see this and they might not purchase the stock based on the high price, even though it may be worth it. We talked earlier in the semester when we're talking about ratio analysis that things like the price-earnings ratio is a good way to measure how expensive a stock is. It doesn't really matter what the stock is selling for. You want to look at something like the PE ratio. But again, there's just a widespread belief that the optimal price range is around $20 to $80 per share. And if it gets above or below that, you either have a stock split or a reverse stock split. And as it says, stock splits can be used to keep the price in the optimal range. And stock splits generally occur when management is confident, and so this is interpreted as a positive signal. So a lot of times what you will see is you will see a stock split. Initially, you're no better off, but then you see the price of the stock start increasing again, and of course you've got 2 times, or if it's a 2-for-1 split, or maybe 3 times as many shares if it's a 3-for-1 split. So you're actually your value is actually increasing after the stock split. And that is a very quick overview of dividend policy. Again, I would take a look at in your book at the topics that I covered in the slides here. But basically, you know, looking at the slides, taking a quick look at your book, there are no calculations from this chapter, and you should be good to go for the final exam. So if you have any questions, please let me know.